What's up, you guys? Welcome back to Business Buzz, where we focus on business, entrepreneurship, and investing. My name is Carson Ross, and today I'm going to be going through my $4,000 risky stock portfolio. Now, you guys, I actually started investing on May 8th, 2020 because I turned 18 on May 2nd. So 6 days later, I was already an investor in the market. So while I haven't been investing that long, I've been investing for as long as I can. Since May, when I started investing in this portfolio, it's given me a return of about 48%. A nice cool 48%. That is huge. Or the market as a whole did around 27%. So yeah, both of those are ridiculous returns for just a 7-month time span. I definitely started investing at the right time. And hey, you can't hate me too much for having such a risky stock portfolio because I have nearly doubled what the market's produced. You know, I figure that the younger you are, the more risk that you can take. If I were even 30, maybe even 25 years old, my portfolio would definitely not look like this. But I'm 18 years old with a relatively low amount of capital to invest with. So I say, screw it, let's try to get some major Wolf of Wall Street returns. In total, I have put in over $2,700 into my stock market portfolio, and right now, sitting in my portfolio, I have around $3,600. So I've profited around $950. $30 of that gain was not due to market gain, but rather dividends that were paid out to me directly from the companies. So I'm going to walk you guys through each of these 15 stocks that have taken me this far and how much they've gone up and how much they've made me since May. Before we get into the meat of the video though, make sure to go down and please give this video a like, and also don't be afraid to subscribe. You could be within the first 3,000 subscribers on Business Buzz. Subscribe to us now before we get 3 million. Probably never, but who knows. Number one, 24% of my portfolio, that's nearly a quarter of my portfolio, is split between two stocks. And these two stocks play relatively in the same industry. Cybersecurity. So cybersecurity is all about data protection. It's all about the education, the softwares, and the safeguards that can be put into place to protect computer information. It's becoming increasingly essentials for businesses and just regular people like you and I to start investing in cybersecurity. And I don't just mean the stocks, I mean for ourselves. I mean, cyber threats are becoming a really big deal. So much money and time is stolen on the computer nowadays, and it's important to put these safeguards in place to protect your information. So like I said, every year more and more crimes are committed in the cyberspace, and that means that more and more jobs are opening up in this breakout industry. And I still believe that cybersecurity is completely undervalued as a whole. Cisco and Palo Alto Networks are the two stocks that I split my money between when it comes to cybersecurity. They are well-rounded and well-positioned for the future in this realm. So both of these stocks make up 12% each of my portfolio. Together, cybersecurity-focused stocks make up, again, nearly a quarter of my entire portfolio. So that's very risky, but it's just because I am so bullish for this industry and specifically for these two companies. So since I started investing in May, Cisco has gone up 56% and Palo Alto has went up 9.5%. Averaging the two out, I've made a little over 33% between these two stocks. So far, this has profited me $156 at the end of the day. Next up, 14% of my portfolio is invested in Dunkin brands. Of course, Dunkin is a brand that owns both Dunkin' Donuts and Baskin Robbins, two food groups in which people are addicted to: ice cream and coffee, and it's good to invest in addictions. They've also got a great social media presence for both of their businesses, Dunkin' and Baskin Robbins, and really the whole backbone of that is not even paid advertising. It's teenage girls posting their daily lattes on the Snap. Interestingly enough though, I'm talking as if Dunkin' brands is still a thing. They're not. A few days ago, it's official, they have been purchased by Inspire Brands. Inspire Brands now owns nearly 32,000 restaurants worldwide. They are quickly, the past few years, Inspire Brands is quickly building a giant food empire. Inspire Brands owns Arby's, B-Dubs, Sonic, Jimmy John's, and now Dunkin and Baskin Robbins. I'm not gonna lie, I got really lucky because of this acquisition. Dunkin stock reached a new high because of this. Inspire Brands is purchasing every Dunkin stock for $106. So I'm getting $106 for every share of Dunkin that I own. Now, of course, the only downfall to this is now I have to find a new place to put this cash. And unfortunately, Inspire is a private brand. So give me some food-related companies because I want to stay in the food sector in the comments below for me to invest in. Because of the 70% increase, I've been able to profit $193 just from Dunkin Brands. It's important to have a sector of your portfolio designated for a few, or in my case, one financial-related company such as a bank, or in my case, an insurance company. 10% of my portfolio is invested in a company known as Prudential Financial. When I found this company back in May, I realized that just about every fundamental measure that you can look at in a stock screamed undervalued, very undervalued for Prudential Financial. Of course, back in May, just about every stock was trading for an undervalued price, contrary to now where many experts believe that stocks are overpriced. But when I saw Prudential Financial, I saw something way more special and way more undervalued. I've gotten a 44% return on this stock so far. That's profiting $105, and I still believe this company is pretty undervalued. I'm very excited to continue getting good returns and a solid dividend payout in the coming years with this stock. My next stock, DELL, is a great technology company that is well positioned to be a major player in the cloud computing sector. They've shown that they are a company that can adapt well and fast, which is something that I value a lot, especially in technology companies where everything changes. This stock has garnered me an insane 74% return, and that translates to about $121 in take-home profit. Number 5 is Johnson & Johnson. This is definitely my safe stock of the bunch. It is a massive company and also allows my portfolio to have a foothold in the healthcare industry, which is something that the rest of my portfolio lacks, so it gives me a bit of diversity. While it is my worst performing stock, that's something that I definitely expected. I know it's more of a dividend stock that can give me money and consistent returns as the years go on. It's only improved 9% since May. Now, any other year in the stock market, going up 9% in 7 months would be amazing, but this year, that's actually underwhelming. You know what though? I'll take that 9% as well as the $18 in profits that I've earned from it. Another 8% of my portfolio is split between another 3 stocks, all within the renewable energy industry. It's a fact, renewable energy is the wave of the future. And in my personal opinion, NextEra Energy, Renewable Energy Group, and TransAlta Corporation are the 3 companies that are pretty big in this industry and have a good track record, and I think they will continue to do well going forward. Renewable Energy Group is actually the most well-performing stock ever in my portfolio. It's gone up 220% since I started investing. That's a profit of $141, and NextEra and TransAlta also gave me 34% and 28% returns respectively. So all in all, this sector of my portfolio has given me 110% return. That's over $170 in profit. It over doubled my money in just 7 months. Thank you, Renewable Energy. Another 8% of my portfolio is split between another 3 stocks, this time in the gaming industry. Gaming is becoming more widespread every single year. It's getting more mainstream as the days go on, and not to mention it's getting better and more immersive all the time with every new game that comes out. So the 3 stocks that I have in this portfolio are not split evenly. Half of it is in Sony, a third of it is in EA, and the remaining 17% is in Take-Two Interactive. In total, these stocks have averaged me a 43% return and a total of $67 in profit. Thank you, gamers. Another 7% of my portfolio is tied up in a cannabis ETF known as ETFMG Alternative Harvest. Both people's views and recent policy changes and just the way the world is going has proven to me that the cannabis train is one that is not slowing down. It's chewing, and it's going to run all through the country and all through the world. It's becoming legal in more states and regions every year, and now the majority of the public is behind that. It's becoming legal for both recreational and medicinal purposes, and there are even a lot of talks about cannabis becoming a federally legalized substance. There's plenty of legal money to be made in this market, and I don't know too much about this industry, so instead of picking a few stocks that might tank, I just decided to pick an entire ETF. Basically, that'll track the entire cannabis market, and I think the market as a whole is going to do well, so I think this position will do me well. So far, this stock has garnered me 18% and around $21 in profit, but this is the one stock on the list that I actually didn't start investing in until a few months ago. All these other stocks I was invested in since May, but this one is a newcomer because I believe in it so much. Next up, we got Alibaba, which is the perfect company to diversify into a foreign market. It's a massive company, it's well managed, and it seems to be taking all the right steps moving forward. I truly don't believe this stock will go below $200 a share again in my lifetime, so if it ever goes below $200 a share, I'm going to be loading the boat on some Alibaba shares. So far, I'm just up 28% and $29 in profit on this stock. Not too shabby at all. So lastly on this list, 5% of my portfolio is into Carnival Corporation, and I had a really good reason for buying the stock, the best reason of all, because financial education Jeremy said to do so. I will blindly follow this guy into oblivion. He makes killer picks all the time. He's like, I don't know how he does it. I think he sold his soul to the devil or something. So without much research behind it, I know this is bad to do, but I bought the stock. It is my riskiest stock, but it also is one of my most well-performing stocks. It went up 72% since May and profited me a total of $66 so far. I mean, this was a super risky position. Back in May, there were a lot of talks about potential bankruptcy still with this company, but I think it's safe to say that Carnival Corporation is getting back on its feet. So guys, do you think my portfolio sucks? Make sure to comment that down below in the comments, even though I know you already will. But if you thought, wow, 50% since May, that's great. Also be sure to comment. Anyway, thank you guys for watching. Be sure to subscribe to Business Buzz, and I will see you guys in the next video.